Hey YouTube, welcome back to my channel. My name is Dr. Daniel Kaplan, and my mission is to make psychology accessible to all. In today's video, we're going to talk about the psychology of bank runs. And it's a deviation from some of the other videos I've been putting up lately, but I thought with current events, let's talk about it. So the first thing is, well, what is a bank run? Well, a bank run is when there's panic in the banking industry. And due to that, there's a select few number of people who take out their money. And then more people take out their money. And then eventually the withdrawals supersede the reserves of the bank. So they have to start selling off some of their bonds or treasury notes, and it creates a vicious cycle, and it can create the insolvency of a bank, right? So that's a bank run. And in general, most people don't even realize how banks work. So banks work based on this premise that you're going to deposit money. They're going to be the steward of your money. They're going to hold on to your money. But according to FDIC regulations, they only have to hold on to about 10% of your money. So how do banks make money? They take the other 90% of the money and invest it. And usually they invest it in stable bonds, treasury notes, things like that. It'll give them a small, bump in maybe 10 years off of the interest rate or whatever. But in stable times, a bank's like, okay, with the amount of money, the volume of money I have, I'm going to make money off of your money. And that's why they give you some money back in terms of interest rates as well. But with bank runs, that becomes tested. And that's what happened with Silicon Valley Bank, was that they put money into treasury notes, and the interest rate that these treasury notes were at was about 1-2%. But as we had this issue with inflation, the rates had to keep going up. So the Fed decided we're going to bump up the interest rate. Sometimes it's, 1/4%, 0.5%, 0.75%. And then at a certain point, the interest rate got it to the mid to high 5%. So here are people who were saying, well, wait a minute, I'm only getting a couple percent. It might be better just to break whatever that was, pay the penalty and reinvest. So with SVB, which is Silicon Valley Bank, that was one domino that fell, was as the Fed rate increased, people were withdrawing money and buying at a higher interest rate because they're going to make out better in the long run. The other thing that happened specifically with Silicon Valley Bank was they are very focused on the tech sector. So technology startups and healthcare startups and things like that. And in the past few years, there have been fewer venture capitalists putting money into it. So people are having to lean back on the money they had in the banks. So some people started to draw down. They drew some money out to pay their bills, to keep their startups going. And that, coupled with the Fed increasing interest rates, it started this domino. And here's what happened in terms of a bank run for SVB. We're seeing it with Signature Bank, and we're even seeing it with Credit Suisse, which is a really big international bank, which is in jeopardy of being toppled because they're overextended in what they put money into. So the word got out that SVB was going to have to start selling assets in order to pay for the withdrawals and give people their money. So when that happened, that panic got out to other investors. So one person said, hey, you really need to take your money out of SVB because it's going under. And then other people, word of mouth, word of mouth, word of mouth, started to grow. And people pulled out money more and more and more. But how does this relate to psychology is there are two things we need to know. Bank runs are driven by anxiety or uncertainty as to what's going to happen with that bank. So we have to pay attention to panic and anxiety within a single bank. But I mentioned other banks because there's something that we need to keep an eye on going forward, which is called a contagion or a contagion effect. As one bank fails, it creates further uncertainty about the banking market as a whole, which could create more people pulling out money and money from other banks. And there are vulnerable banks out there, not just SVB and Signature Bank. There are regional banks out there that are, they don't have the same level of assets as a JP Morgan Chase or a Citibank or Bank of America, these kind of banks. And they're at jeopardy because if a contagion effect takes place, you're going to see more and more people pulling their money. And this same strategy that was used by SVB was used by a lot of other banks, and we might see other banks fall. I hope that's not the case, but I figured I would talk to you a little bit today about what's happening in the banking industry and how anxiety influenced SVB, as well as how the impact of SVB can be carried on to other banks through a contagion effect. I hope you liked the video. If you found it useful, give me a big thumbs up. Click the like button, subscribe, click the notifications tab. More importantly, if you have a reaction to the video, put it in the comment section. I read every comment. I respond to every comment. This is how I turn into a learning community. Until next time, take care, everyone.